Hello, I'm Bill Story of the Alderhood Group, and my guest today is Nick Rilley, who is Senior Investment Manager of Butterfield Asset Management. And today we're going to go over Nick's third quarter review. Hi, Nick.
Hello, Bill. Good to be with you.
Good. Nick, if I may, I'm just going to read the first couple of sentences in your quarterly review that you published, because frankly, I thought it summed it up rather well and quite succinctly. So if I may, I'll just read it and say, the third quarter was a difficult one for financial markets, as both bonds and equities suffered due to persistent inflationary pressures and downgrades to global growth expectations. Multi-decade high inflation rates have forced central banks to tighten monetary policy through interest rate hikes and the removal of liquidity from the financial system. So, Nick, following on from that, I wonder if we could just have a brief chat, perhaps, about, when you're talking about the monetary policy or, tightening the money supply. What does that sort of mean, shall we say, in layman terms, its impact on prices or inflation, et cetera, et cetera?
So it's a good question, and it can be a very technical answer when you start to dig into what does it mean by things like the money supply. So you can think of the money supply as being, just very broadly how much money there is out there in the system in terms of notes and coins, money on deposit, money in money market funds. And that's what central banks used to target. They used to have a kind of a target and think, let's try and target the amount of money that's out there in the system. But then they realized that that's very, very difficult because the world has become a lot more financialized. The banking system is a lot more important in terms of its role in the creation of credit, the creation of essentially money in the system. So then they moved to a system where they started to focus on interest rates and unemployment. So most central banks will have an inflation target. So they are trying to keep the inflation rate around about 2%. So that's generally what central banks are targeting. And they have some tools that they use to try and keep inflation rates low. The primary one is interest rates. So they will adjust interest rates higher or lower depending on their outlook for inflation. So what they then kind of realize is that interest rates don't really capture the whole monetary system that we have out there. So then they're using a much broader term now called financial conditions. So financial conditions brings together a lot of different measures, most of which have some orientation towards credit in the economy. So how expensive is credit? So by putting up interest rates, essentially they're increasing the cost of money. And then in doing so, the cost of credit across a wide range of different market kind of functions gets more expensive. So things like mortgages being the obvious one for housing, things like auto loans, if you want to buy a car, how much are people paying in terms of the interest rates. So they're really trying to target a very broad measure of financial conditions. And it also includes things like stock markets as well. So if the stock market goes up a lot, that loosens financial conditions. There's more wealth out there in the system. People feel more confident. And so what they're trying to do now essentially is to tighten that global financial conditions index that they track. And they're watching things like mortgage rates. They're watching things like the equity market. They're watching things like corporate credit spreads. And what they're trying to do is tighten this system. But the trouble is what they do today has these proverbial long and variable lags. So what they do today might not impact the real economy for 6 to 9 months. So it's very, very difficult for them to calibrate this, tightening of global financial conditions in a way that helps to bring inflation down, but it doesn't tip the economy into a big, deep recession because they don't want that to happen because that would be very painful for unemployment rates.
That leads me into a slightly different angle on that, if I may. You're talking about high inflation rates, and they are global. In other words, pretty much every, call it developed country in the world, if you wish, is currently suffering, high inflation. How does that correlate in the sense that, do all the central banks talk to each other? And I would imagine that they do. But if the Fed in the US increases interest rates and affects inflation or hopefully does help inflation. How does that sort of reverberate, if you wish, across into the European markets, for example? Does interest rate hikes in the Fed impact the inflation in the UK, for example, and obviously around the world?
Yeah, so inflation is high across much of the world. The main exceptions are China. So China didn't stimulate the economy through COVID like the West did. What they did is they focused on, trying to keep factories open rather than giving monetary help to consumers through furlough schemes and stimulus checks. So inflation in China is relatively low, and Japan is also a bit of an exception. So a lot of inflation in the West has come from higher housing costs, whereas Japan hasn't quite had that dynamic. But you're right, there's been a lot of inflation across a very broad range of countries. So this dynamic of what it means when the US puts up rates to fight inflation in the US, what that means for the rest of the world is quite a complicated dynamic. You're right that the central banks, they do talk to each other. They share information. They obviously know what they do in the US does affect countries in the rest of the world, but there's varying degrees to which they can actually do much about that. So the Federal Reserve has a very specific mandate that relates to US inflation and US unemployment or full employment, which is something that they're targeting. So the US Federal Reserve doesn't have a mandate to manage inflation, in other countries or manage financial conditions in emerging markets, for example. But they know that what they do does feed back to the US to varying degrees. So the main issue that we've had is that the US has been putting up interest rates significantly to try and keep a lid on inflation in the US, but that's meant that the dollar has been very strong. So it's sort of forced other countries to respond and to put up interest rates in their own country to stop their currency devaluing versus the dollar, because that will be quite inflationary for other countries as well. So they're forcing other countries to essentially tighten as well. And there are different degrees to which that's warranted. So in somewhere like the UK, there's a lot of inflation in the UK. So central bank tightening in the UK is warranted. In Europe, it's a bit of a difficult situation because a lot of the inflation there has come from an energy shock. So the ECB putting up interest rates because of an energy supply issue through natural gas coming or not coming through the pipes from Russia. Central bank, higher interest rates are not the way to deal with that. So it is causing problems around the rest of the world. But as I say, the Federal Reserve doesn't have a mandate to manage conditions in the rest of the world unless they feed back. And right now, they're not really feeding back. They are starting to feed back through things like global manufacturing. So that cycle is weakening, and that will translate to weaker growth in the US. And then it becomes under the Fed's remit to incorporate that into their decision making.
Let's move into a couple of the sectors then, the fixed income sector, the bond market. Now, we obviously, we realize that interest rates, high interest rates versus low interest rates has an effect on bond market values, etc., sort of thing. Are there any, as it were, indicators currently in the bond markets to give us some idea of not so much where inflation is going to go, but the cyclical nature of the bond market being impacted by higher or lower interest rates?
Yeah, so the bond markets had a lot of pain this year because of higher interest rates. So higher interest rates means that higher yields means lower prices for bonds. So it's been a painful year for bonds. So a lot of it is related to inflation and the central bank's reaction function to that inflation. So the Federal Reserve has said that inflation is way above target and they're going to respond with higher interest rates. So the bond market has then reacted to that rhetoric and those interest rate moves. And it's been quite a painful period for the bond market. But in terms of the inflationary aspect to it, so there are different types of bonds out there. There are inflation-linked bonds. So in the US, they're called TIPS, Treasury Inflation Protected Securities. In the UK, they're called kind of linkers, index-linked bonds. So what you can do is you can look at the yield on inflation-linked bonds relative to the yield on regular nominal bonds. And then you can see the difference between those yields. And then that's something they call an inflation break-even. So you can, extract information from the bond market around what the market is thinking about future inflation. So one of the interesting things that we've seen over the last year or so is, while, you pick up the newspaper or you read, the financial press, and there's a serious amount of bad news about inflation, if you look at the pricing of index-linked bonds, it's not suggested that the market's that worried about inflation, which is kind of an interesting, dichotomy. It's partly because the central banks have said we're going to react, that the probability of, out of control inflation therefore is lower. So that's part of it. But that's one of the curious aspects that we've seen. And it was one of the reasons why central banks were a little bit slow to react to this inflation, because they weren't getting big red warning signals coming from financial markets. So the bond market thinks that inflation is going to come down quite significantly next year. And that's probably right, on the basis that, from these levels, there's going to be a lot of disinflationary pressure, as things like durable goods that went up in price a lot through COVID are going to start to come down. Things like secondhand cars, they got very expensive. They're now starting to come down. So that's what the bond market is telling us, that inflation is going to come down. But we really need the bond market to be right about that, because lower inflation is going to help with this central bank issue that they have around inflation. So if it comes down, it allows them to be less aggressive in terms of higher interest rates, which would be really helpful for financial markets.
We've always sort of known that, as we call it, buy the dip has been a good strategy in equities, for a number of years. In other words, not so much the stock market in itself, but any particular stock, if it goes down, a lot of people work on buy the dip. In other words, we'll buy in at the lower price on the basis that we think and hope that it will come back up again, as when all boats, as it were, rise again. Is there anything new within the market environment that we should be considering, thinking again about? Should we buy the dip, or should we sit tight, or something like that?
It's been a really good characterization of especially the equity market in the period after the global financial crisis, so around about 2009-10, right through to last year, really, that whenever equity markets have gone down, the right thing to do, the right trade, has been to buy, and then we'd see this recovery in prices. So one of the main reasons for that was that every time something bad happened, there was a policy response to counteract it. So if you think 2011, 2012, we had the Eurozone debt crisis. So that was a bad period for markets. But what happened was the ECB basically said, we're going to stand behind the sovereign bond market, try and attack the market if you think you've got a bigger balance sheet, and nobody does. So that really settled down the bond market in Europe. So equity markets rebounded. Then we had some issues in China in 2015. They responded with a big fiscal stimulus package that worked very well to sort of bring the global economy back out of that mini slump that it had in 2015, early 2016. And then COVID was obviously a huge shock, but it also had a huge policy response in terms of monetary easing plus fiscal policy to help households and businesses through the crisis. So every time something bad happened, we had a policy response. So that meant that when markets went down, they kind of recovered quite quickly. Now, the challenge we have now is that inflation is a problem, and it hasn't been a problem for very many years. So that constrains policymakers. So if you look at what's happened in the UK in the last few weeks, what's happened is partly we've had an energy crisis where energy prices have gone up a lot, and the governments have said, we're going to start capping the price of energy for households, which is sort of a noble endeavor, and it has some very strong merits, particularly with people on low and middle incomes in the economy. But what's happened is financial markets have reacted to that and said, you can't really do that because inflation is already 10%. So we can't have more stimulus going into the system. So policy has gone from something that's been really helpful in a world of low inflation to something that's actually part of the problem now in this higher inflation environment. So that's why the buy the dip hasn't really worked this year, because the problem is inflation, and it's a very difficult thing to get a handle on. I mean, central banks can put up rates, and inflation rates will ultimately come down. You can take it to the extreme of putting interest rates up to 10%, and then you'll cause a huge recession, and then inflation will come down. It's just guaranteed. But as I said earlier, central banks don't want to cause too much pain. So they've actually been inflicting pain on the equity market this year by tightening financial conditions. So that's been why this buy the dip hasn't worked so far this year.
But I think obviously, what you're saying then is don't throw away the concept. All things being equal, as we sort of come back out the other side, hopefully, in the not too distant future, then, the buying the dip concept as a strategy, as an investment strategy, especially in the equity markets, will sort of come back again. So it's not a case of throwing it away because it will never come back. It's going to take a little bit of time for it to come back. Is that a fair statement?
Yeah, I think so. I think there's a saying about the pendulum of fear and greed and human behavior. You get too optimistic, and then the market gets too pessimistic. And when it's too optimistic, it's sort of, with the benefit of hindsight, a good selling opportunity. And when there's too much pessimism out there, as you say, things will get better. There's a lot of investment going into the energy transition. So while there's an energy issue today, there's a lot of investment that's going into new technology, for example. So you wind the clock forwards a few years, and things from a growth perspective should look a lot better because there's a lot of investment to try and overcome this problem. So you're right, there is this sort of pendulum of fear and greed.
Well, I think that just about wraps it up for this quarter's review, Nick. So I'm thinking that perhaps at the end of the year, when you're doing your fourth quarter one, we can have a look at how have the different sectors been performing, and we've then probably got a more like an annual review of some of them, because traditionally some of the sectors have been performing better than others, which is fairly obvious. So I think we'll catch that the next time. So my thanks again to Nick Rilley, Senior Investment Manager at Butterfield Asset Management. This is Bill Story of the Older Two Group signing off, and we'll catch you again. Take care, everyone. Bye.